Good morning. My name is Rob Mizey, and welcome to my continuing series on international tax issues. Today, we're going to be talking about tax issues for the CARES Act. A lot of clients have been calling me lately and wondering, Rob, what is in the CARES Act from a tax perspective for international taxpayers, for either foreign-owned U.S. companies or U.S. companies going abroad? Well, the actual provisions that everybody talks about are really more domestically oriented, but there are several international tax implications that are yet to be resolved. Let's start with the biggie. Everybody's starting on Friday and this week is applying for Paycheck Protection Program loans through the SBA. And the key feature there is the cancellation of the indebtedness. Will there be cancellation of indebtedness income? No, there isn't. How might this affect a U.S. taxpayer with foreign operations? Well, chances are you're going to be taking a foreign tax credit. Is that income? That is really cancellation of indebtedness income, but which is not going to be cancellation of indebtedness income because of the CARES Act. Is that untaxed income that should go in worldwide income for purposes of the foreign tax credit limitation? Nobody's saying anything. I bet a lot of people in Washington haven't even thought about that issue, but it's out there, and it could impact your foreign tax credit limitation. Next, I want to talk about the alleviated NOL limitation, these net operating losses. Starting in the 2017 Act, we can't carry back NOLs. We can only use them to offset 80% of income. However, if you look at my hypothetical fact pattern here, the 100 of loss in 2019, we can only use 16 of them against 2020. As a result of the CARES Act, we can carry them back to 2017 and 2018, eliminate income. And more importantly, get a refund, get your refund claims in. There's lots of tricky statute of limitations issues with respect to refund claims that you have to cross your T's and you have to dot your I's. There's also some transition tax implications. You may remember Section 965N from the transition tax, which many people have thought of as the one-year wonder. That 965N election said that you be using your NOLs against the transition tax. Well, how is that going to interact with, say, for example, a taxpayer that's paying their transition tax in installments over 8 years? It's an unresolved issue. And before you start thinking of using NOLs and carrying them back and starting to take refund claims, filing for refund claims, you have to resolve this issue. There are other benefits. I list them here. I want to talk primarily about the first and the fourth. 163J, the limit on interest deductions, that increases from 30% of adjusted taxable income to 50% of adjusted taxable income. Also, there's all sorts of tricky rules as to what years adjusted taxable income you're going to use. By the way, adjusted taxable income is a term of art in Section 163J. It appears nowhere else in the Internal Revenue Code. The other big one I want to talk about is excess business losses. The 2017 Act said you couldn't take more than $250,000 of excess business losses. The CARES Act removed that prohibition, but what's the international twist? Here's the international twist. When you're determining excess business losses, you cannot take advantage of the GILTI. That'll never get old. I love my gavel. You can't use the GILTI deduction in determining the excess business losses. Well, thank you for joining me. If you have questions about any of these issues I've raised, please contact me. I look forward to talking with you next time.